Mining industry leaders are keen to establish a new platform after the national election. Minerals Council SAC Mzila Mthenjane says this will allow business, labour, government and civil society groups to come together to discuss how to boost the industry's performance and set it up for growth into the future. The comments come as plummeting commodity prices and South Africa's transport and electricity crises have eroded the industry's profits and its contribution to the tax take. The situation has also put thousands of jobs at risk. Anglo Americans rejected BHP's sweetened takeover bid. BHP CEO Mike Henry says the firm's disappointed. He's added that BHP continues to believe that the revised proposal would be a win-win for all shareholders and that BHP and Anglo American are a strategic fit, with a combination being a unique and compelling opportunity to unlock significant synergies. Calgro has declared a maiden dividend during its full year. The diversified property developer will pay out 9.49 cents per share. That's as headline earnings per share rose 24%. The residential property development sector remains the largest contributor to the group's performance. And while the firm's Memorial Park segment is gaining momentum, CEO Vikas Latachan says the housing market is where the company's focus will be. This is supported by Calgro's move to develop the Bankenveld District City project. The venture will add up to 30,000 housing units in Johannesburg's northern suburbs, and it's estimated that it will double the developer's project pipeline with anticipated revenue in excess of 18 billion rand. Raubex has increased its full-year headline earnings by 21%. That's as tender activity picked up towards the latter part of the financial year, and the construction and engineering group's order book expanded. A final dividend of 92 cents per share has been declared. That reflects growth of 21%. WeBuyCars has reported a 26% rise in core headline earnings for the first half. That's despite a tough trading environment characterized by high interest rates and fuel costs. The group says it managed to survive these challenges due to a number of reasons, chief amongst them being higher average selling prices, improved margins, operational efficiencies and high inventory turns. WeBuyCars expects the difficult market conditions to continue, but believes it is still well positioned to continue on its growth journey and double its market share by 2028. And Vodacom has reported a 10.8% decline in headline earnings for the year to end March. The telecoms operator has cited a combination of startup losses in Ethiopia and higher finance and energy costs as some of the factors that weighed on profits. The performance has meant a cut in the payout to investors. A final dividend of 285 cents per share has been declared. This takes the total for the year to 590 cents, which is down close to 12% from a year ago. Looking ahead, Vodacom says it will look to expand its partnerships across Africa to power the group's growth. And the firm also highlighted that while the global economic outlook is uncertain, it's encouraged by the recent macro reforms in Egypt and Kenya. Further afield, fast fashion giant, according to sources, Shein is stepping up preparations for a London listing after its attempt to float itself in New York faced regulatory hurdles and pushback from US lawmakers. Here's more detail in this package report.
Shein looks to be headed for a share sale in London. Two Reuters sources say that's now the plan, amid stumbling blocks to a listing in the US. The fast fashion giant has faced regulatory hurdles and pushback from lawmakers in Washington over alleged labour malpractices. Instead, one of the sources says Shein will file for a listing on the London Stock Exchange as soon as this month. One source says it was valued at $66 billion in a funding round last year. That means any IPO could potentially be one of the year's biggest and a coup for London, which has been struggling to attract big names. There was no comment on the Reuters report from Shein or stock exchange officials. Meanwhile, the plan for a New York listing is still officially active. But a separate source says Chinese regulators have warned Shein against the move due to the controversy over its supply chain. The firm reportedly still prefers New York as a listing location and is watching for a change of stance by US watchdogs. One option is said to be a secondary listing in the city sometime after London, if and when the US political climate grows more favourable.
Well, for nearly a decade, China has held the position of Germany's primary trading partner. However, the United States has recently overtaken China in the first quarter of this year. Here's our reporter Anatin Devu with more on this development.
Well, that is right, Zinati. For nearly a decade now, China has held the position as Germany's primary trading partner. But as of late, the United States has overtaken China, becoming Germany's top trade partner in the first quarter of this year. Joining me now with more on this is DW's Chiponda Chimbelu. Chiponda, thank you so much for your time. Tell us how China slipped behind the U.S.
Thanks for having me. Well, it all comes down to the latest trade volume figures. Exports and imports between the US and Germany amounted to 63 billion euros from January to March this year. That figure is 3 billion euros higher than the volume of trade between Germany and China in the first quarter, which came in at 60 billion euros. The latest trade data shouldn't be that surprising for those who follow Germany-China trade closely. China's lead over the U.S. as Germany's leading trade partner has been narrowing in recent years. Analysts say economic trends may be behind this development. While the U.S. economy has been doing well in recent years, the Chinese economy has been struggling. So what we are seeing is Germany exporting more to the U.S. at a time when Chinese demand has been slowing.
And Chiponda, what do the latest figures say about Germany-China trade relations?
The latest figures could be a reflection of ongoing geopolitical trends. At least that's what economists are saying. Germany is moving away from China, which it considers a systemic rival. Berlin has been urging German firms to de-risk from China, and as a result, that could be shifting the trade volumes towards Germany's transatlantic partner, the United States. But it's also worth noting that the Chinese economy is more sophisticated now than it was, say, a decade ago. That means that Chinese businesses and consumers are also buying more goods locally. And here in Europe, Chinese companies are also competing more with their German peers on the European market itself. That is definitely the case when it comes to electric vehicles. In fact, about a third of China's electric vehicle exports head to the EU, according to an estimate by Bloomberg News. And that's, of course, ruffled some feathers in Europe. That's why the EU is investigating whether Beijing's subsidies for electric vehicles give Chinese-made EVs an unfair advantage in Europe. That decision has, of course, soured relations between China and EU countries, Germany included. And any tariffs, of course, in the future on Chinese EVs could worsen relations between the bloc and China.
Speaking of relations, Chiponda, can we expect the trend to continue?
Well, China's economic slowdown and its low interest rates are leading EU companies to move their profits from the Chinese market, according to a survey by the EU Chamber of Commerce in China and consultancy firm Roland Berger. The sentiment of European firms about the Chinese economic outlook has fallen to the lowest level in a dozen years. But there's still some uncertainty over whether the U.S. will really overtake China for good as Germany's leading trade partner. One major reason for that are the upcoming U.S. elections. We will have to wait until November to find out who will be the president. So no one knows if we'll be getting a continuation of Biden's economic policies or new ones under a second Trump administration. The expectation is that another Trump presidency could lead to new tariffs on EU goods.
Well, thank you so much for those insights, Chiponda. Let's leave it there for now. That was DW's Chiponda Chimbelu.